Gold just ripped higher again for the third straight day, and here's why. The primary catalyst: China has lowered its yuan fix once again. This signals a deliberate move to devalue its currency ahead of key economic data. A weakening currency like this sends a strong message to global markets. Beijing is bracing for economic pressure. Likely reasons: increased trade tensions and softer domestic demand. But when a major central bank like the People's Bank of China lets its currency slide, it doesn't happen in a vacuum. A weaker yuan makes Chinese exports more competitive, sure, but it also raises concerns over capital outflows, currency instability, and broader global financial stress. And that's exactly where gold comes in. Gold thrives in moments of uncertainty, especially when trust in fiat currencies begins to waver. As the yuan drops, investors, both in China and globally, are turning to gold as a hedge. It's not just about inflation anymore, it's about trust. Trust in currencies, trust in policy, trust in the entire financial system. Today's gold rally isn't simply a reaction to headlines. It's a reflection of deeper market anxieties. With geopolitical risks rising, trade tensions escalating, and China signaling distress through its currency, gold is reclaiming its role as the ultimate store of value. While most anticipated weakness due to new U.S. tariffs, China's economy surprised with stronger than expected numbers. GDP growth hit 5.4%, beating forecasts. Retail sales were stronger than anticipated. Factory output up, unemployment lower than the previous month. On the surface, this looks like a solid comeback, but it might not tell the full story. Many economists speculate that this strength was front-loaded. Exporters likely rushed to ship goods before tariffs spike further, making the figures look better than they are. UBS has even slashed their full-year forecast for China, warning that the real slowdown is still on the horizon. Now, with the U.S.-China trade war heating up again under President Trump's second term, Beijing is going all in on boosting domestic demand. They've introduced a substantial 30-point stimulus plan to spur consumer spending. Yet whether this is enough to power through the external shocks remains the big question. The gold market isn't waiting around to find out. It's already flashing warning signs to the global markets, indicating that investors are preparing for continued volatility. If you want real-time market insights without the noise, follow and subscribe to Macro Junkie. We decode the chaos so you don't have to.